Okay, let's unpack this. We're taking a deep look today at Newgen Software Technologies Limited. Specifically, we're reviewing their Q2 financial and business performance. That's for the quarter ending September 30th, 2025. Now, these guys just posted a pretty impressive quarter, marked by strong growth, but I think the real story is how they got there.
That's exactly right. Our mission today isn't just, reading off the numbers. We really need to dissect what's driving this. Things like their rapid shift towards an AI-first strategy and the efficiency gains that seem to be coming with that. Plus, how their push for global traction is kind of reshaping their whole revenue picture.
Yeah, and the headline figures certainly do grab your attention. Consolidated revenue from operations, it hit Rs 4,008 million. That's about 401 crore rupees, and that's up 11% year over year compared to Q2 of FY25.
Right. And, often more telling than the top line is the bottom line. That grew even faster. Profit after tax, or PAT, climbed 16% year over year, came in at Rs 817 million, which gives them a really, really strong 20.4% PAT margin. Whenever you see profits growing faster than revenue like that, it usually means the underlying business model is getting more efficient, gaining leverage.
Healthy. And I found that mix of stability and expansion really interesting. They didn't just grow, they also added 15 new customer logos, which builds that base. And crucially, their subscription revenue, that really high quality, predictable income that jumped 20% year over year. Okay, before we dive into the strategy side, let's get a bit more specific on the money. How exactly did that Rs 4,008 million in revenue break down in Q2? We kind of need to see the pieces to understand the shift you mentioned earlier.
Absolutely. Good point. So the company breaks it down, and you can see a clear lean towards predictable income streams. The biggest chunk is what they call annuity revenue. That total Rs 234 crores. Now, this bucket includes things like support, cloud, or SaaS fees, and something they term ATMC.
Okay, let's pause there. 8 ASAMC. That sounds a bit like jargon for anyone listening. What does that actually mean in practice?
Yeah, fair point. Think of it as the essential recurring fees needed to keep their big software systems running and up to date for clients. ATS is annual technical services, and AMC is the annual maintenance contract. Basically, these are payments clients make year after year. It's predictable, reliable income for Newgen. It's not tied directly to selling a new license or a big new project.
Got it. So it's like the bedrock income, predictable payments for keeping critical systems going.
Exactly right. And within that annuity stream, remember, the subscription part alone was Rs 126 crores. That's where that strong 20% year-over-year growth came from. The rest of the revenue came from the, let's call them lumpier sources. Revenue from selling products or licenses outright was Rs 74 crores. And revenue from implementation services and other bits was Rs 93 crores.
Right. So if you add it all up, that annuity stream makes up, what, almost 59% of the total revenue for the quarter. That feels like a much less risky profile compared to a company just chasing those big one-off license deals all the time.
Oh, absolutely. It signals a strategic choice. They're clearly optimizing for that long-term visibility and stability.
Okay, so let's pivot now from the numbers to the strategy, the boardroom view. What was the management commentary like? The chairman, he highlighted two main things, right? Strong growth coming from new geographic markets and also breakthroughs, landing large deals in their more mature markets.
Yeah, and the CEO, Vrinder Jeet, he kind of drilled down into where those big deals are happening. They're putting a lot of effort into the banking vertical, specifically helping banks build out complex customer journeys. But maybe the bigger strategic push is in insurance. They're really expanding into the policy administration system space, PAS.
Okay, PAS, what does that signify? Moving into policy administration.
Well, PAS is basically the core operational engine for an insurance company. It handles everything, from quoting a policy, underwriting it, managing claims, servicing, the whole life cycle. So by targeting PAS, Newgen isn't just offering a side tool anymore. They're aiming for the central nervous system of these large insurers. And that immediately jacks up the potential size and importance of the contracts they can win.
That sounds like a much deeper, more embedded position. And I guess underpinning all this is a pretty significant investment in tech.
Huge. Absolutely. This seems to be the real cornerstone of their whole strategy right now. They're accelerating what they explicitly call an AI-first approach, and they're backing it up with money, dedicating a substantial 10% of their total revenue just to R&D, plus another 21% to sales and marketing, presumably to push these AI-powered solutions. They seem to view AI not just as a feature, but as something, foundational, transforming everything they offer.
Okay, and here's the bit that really made me pause, and it connects right back to that R&D spend you mentioned. We're seeing 11% revenue growth, right? But the earnings call mentioned their total headcount is actually down, about 100 people fewer than last year. How does that square?
That's the kicker, isn't it? It's like the proof point for their AI investment paying off internally already. Management directly linked this to significant productivity gains, gains driven by AI and automation within their own operations. They even threw out a number, suggesting these tools could boost overall productivity by maybe 20 to 30%.
Wow. That completely changes the usual math for growing a software company, doesn't it? If you can actually grow revenue by 11% while reducing your personnel costs, the leverage is just enormous. It means they might be escaping that old trap where revenue growth always meant hiring more and more people.
Precisely. If they can keep that kind of technological leverage going,
Yeah.
well, the implications for their operating margins, their future valuation, they could be massive. They're essentially building a much more efficient growth engine.
Okay, fascinating stuff on the efficiency front. Let's shift focus a bit to geography. Because the total revenue number, 11% growth, it kind of hides some complexity underneath, regionally speaking. Where did that growth primarily come from this quarter?
Yeah, the momentum this quarter was definitely tilted towards the developed markets. The U.S. and the EMEA regions, Europe, Middle East, Africa, were the clear powerhouses. They reported a combined growth rate of 22% year over year. Pretty strong.
22% combined.
Okay.
And looking at the overall geographical split for Q2 revenue now, EMEA actually took the biggest slice at 31%. India was close behind at 29%. Then the USA at 24%. And APAC, Asia Pacific excluding India, at 16%. So it looks quite globally diversified on the surface.
It is diversified, yeah. But the earnings call added a really important layer of detail here. It's about the mix of that revenue. And this ties back to why maybe the overall growth wasn't even higher, despite that UCMEA strength. Basically, while the global pipeline looks good, those really large upfront license deals, the kind they historically saw a lot of in places like India and the Middle East, those are lagging a bit. They mentioned those specific deal types were down almost 30% compared to last year.
Ah, okay. So why does lagging license revenue in India and the Middle East dampen the overall quarterly number, even if other regions are strong?
It comes down to that critical trade-off. Subscription revenue versus license revenue. See, when they sell into the US and EMEA now, those deals are heavily weighted towards subscriptions. SaaS models. Now, SaaS revenue is great. It's steady, predictable. It builds that annuity stream we talked about, gives you fantastic visibility for the next 3-5 years. But it doesn't give you a massive slug of cash and recognized revenue in the single quarter you sign the deal.
Right, because the revenue gets recognized sort of smoothly over the life of the contract.
Exactly. Whereas historically, markets like India and Middle East often favored those big perpetual license sales. You get a large chunk of cash up front, and you recognize a lot of that revenue immediately. Creates big spikes in quarterly results. So this strategic shift globally towards SaaS and subscription, it's definitely stabilizing the business, de-risking it for the long term. But the natural consequence is that it moderates the immediate quarterly revenue figures. It smooths out the peaks and valleys. They seem to be consciously choosing that long-term stability over those short-term revenue pops.
That makes sense. A strategic trade-off. Okay, so any company making these kinds of shifts needs proof points, right? External validation that their strategy, their products, are actually resonating in the market. What concrete evidence did we see this quarter that validates Newgen's position?
Yeah, they definitely highlighted some key third-party recognition, always good to see. They were named a strong performer in the Forrester Wave report for digital process automation software. That was for Q3 2025. That basically says their platform is solid, competitive for automating complex business workflows. And they were also included in the Forbes Asia Best Under a Billion list again. That came out in August. That's the second time in a row, which is, a pretty strong endorsement of their financial health and market standing.
Okay, analyst reports are one thing. What about actual deals, signed contracts? Were there specific examples of large multi-year wins that show this global reach and strategic focus in action?
Absolutely. They share details on 4 pretty significant wins that really illustrate the strategy playing out. First, over in the UK, they won a project worth about £3 million. This was from a major player in the life and pensions consolidation space. And the deal was for enterprise content management, ECM, and customer communication management, CCM.
ECM and CCM, again, just for clarity, what problems are those solving for that UK company?
Think of it as digital modernization, really.
Yeah.
ECM helps them manage all their vast amounts of documents and data efficiently, securely. CCM is about improving how they communicate with their customers at scale. Think personalized letters, statements, emails, making sure they're consistent and effective.
Yep.
So it's about streamlining those core operational customer-facing processes. Okay, second big win. A major European retail group signed a 5-year deal. This one was for $4.2 million, and it was for a modern cloud-based enterprise records management platform. Again, you see that theme, large multi-year cloud SaaS contract in a developed market. Europe this time.
Right. And what about emerging markets? You mentioned the financial sector focus there earlier. Any examples?
Yep. In Africa, they landed a 5-year contract valued at $5.6 million. This was with a Ghana-based financial group, and it was for implementing a full loan management system. So that shows they're still winning these big core system transformation projects in those growth regions too.
Okay, and finally, you mentioned the CEO's focus on the policy administration system, that PAS strategy and insurance. Did we see a win land there?
We did, a very relevant one.
Yeah.
Back in India, they secured a 5-year deal worth 21.24 crore. This is from a general insurance company, and it was specifically for implementing Newgen's policy administration system. So that directly validates that push into the core insurance space. It shows that strategy is already converting into significant long-term business.
Okay, so let's pull back for a second and try to summarize the main thread here. It feels like Newgen is really in the middle of this transition, doesn't it? Moving away from being just an enterprise vendor relying on maybe sporadic big license deals and transforming into more of a global enterprise platform company underpinned by stable annuity-based revenue. And they seem willing to accept maybe a bit of short-term moderation in reported growth because that long-term stability and presumably the profitability that comes with it is the bigger prize.
I think that captures it well. And that stability, as we discussed, is getting this huge potential boost from efficiency gains. We keep circling back to it, but growing revenue 11% while actually shrinking headcount. That's not the traditional software services playbook.
Yeah.
This could be the blueprint for a new kind of scaling model in this industry, powered by AI.
Which raises, I think, a really important question for anyone watching this space, whether you're an investor or just interested in the future of enterprise software.
Exactly. Given this aggressive investment in AI, that 10% of revenue going straight into R&D, and the clear early results they're showing in workforce optimization, you have to ask, how quickly is this balance between, massive tech investment on one side and human capital on the other going to fundamentally reshape the financial models across this entire sector?
Right.
I mean, if companies like Newgen can consistently achieve productivity gains of, say, 20%, maybe even 30% driven by AI, the whole industry might need to reevaluate how it thinks about staffing, scaling, and ultimately profitability. That, I think, is the really profound underlying question emerging from their AI-first roadmap.
A really fascinating framework to keep in mind as we watch this sector evolve. Okay, hopefully you feel exceptionally well-informed now on Newgen's Q2 performance and the key strategic currents shaping their path forward. Until the next deep dive, keep learning.